go. Okay, we're back recording. So I don't know where I left off or where it ended up, but I'll just carry on with this slide here. What we decided was that if we're going to be planning something and then we put that plan into action, which is directing, then when we direct something or carry on these action plans, we need to make sure that they're working. So in order to make them work, then we need to make sure we have some way of managing them or controlling them. So if we control them, then we have a good way to make it work, and hopefully it can be good work. And then carry on from there. And then we just make changes as we carry on. So it's to help. I don't know whose microphone is off, but if you know, might help with the transmission here. I'll see if I can do it. Hold on. There we go. There we go. Okay, sorry. Oh, what a night, hey? Is it Monday? It must be Monday. So this here shows us an idea of what the organization chart looks like. And this is just more for information only, but what it's attempting to really do is to sort of paint the picture of where the reporting happens and who would be demanding those reports. And so when we think about the chains of command or the lines within the organization, this is normally the way it looks. So we look at really delegating the report generating process and the decision-making process. So that's just there for your information only. So again, I'm just gonna look at some true or false questions here. And really what the purpose of this is to make sure that we understand what the role of the managerial accountant is before we move forward. So managerial accountants have a single role within an organization, collecting and reporting costs to management. Well, we know that's false because their job is much larger than that. They're gathering data, they're delivering data, they're helping make decisions with the data, and they're creating more action plans with the data. So we're all constantly planning, directing, and controlling, and looking for that feedback loop to make sure that everything's working. The second one, financial accounting reports are general purpose and intended for external users. Yes, that is true. Financial accounting reports are for that. Whereas managerial accounting reports are special purpose and issued as frequently as needed. Absolutely true. And we got them all right, of course. The fourth one, managers' activities and responsibilities can be classified into three broad functions: cost accounting, budgeting, and internal control. Well, yeah, I mean, that happens with lots of accounting functions, but managers, not the accountants, extend quite a bit beyond that. They aren't necessarily responsible for cost accounting. That's for the accounting department. They use the data, they don't generate the data. And then the fifth one, managerial accounting reports must now comply with GAAP. That is not true. It does not have any reporting principles whatsoever. You do as you need. So if we look at, asking the questions about what do we do with this information? I mean, the accounting information, the financial accounting information hasn't changed. The financial statements will probably look roughly the same, but it's how we classify them within the financial records that makes them a little bit more unique. And so we're going to move away from their generic, income statement accounts and balance sheet accounts, but not to say they're not any different. We're just not going to focus on the bigger picture. We're focused more on the manufacturing side of things. And I choose manufacturing because it's easier for conceptually understanding what's going on, but you can use this in service industries or not-for-profits as well. So what should we ask ourselves as managers? Well, we, of course, are in business to make profit. If you are a not-for-profit, you are there to provide a service on a cost recovery basis. So if it's not the involvement of making, providing a product, you're providing a service. And the other questions are, if we decrease production volume, will costs also decrease? Well, not necessarily. And then what impact will automation have on total costs? We tend to think of that as being more efficient, but that might not be the case. And how do we best control our costs? So there's lots of ways we can do that, but these are just questions that if we're thinking of bottom line, we need to think about how we can get there efficiently and cost effectively. So that's usually where those questions stem from. And so I pose the question to you to think about these three items. These are just chosen randomly, of course. One is a bicycle, the other being the iPhones. I think that's the 12. I'm not sure. They look big. And then, of course, my favorite, chocolates. These are items that are produced, they're manufactured. And what I want you to think about, though, is, or pick something else. These are just examples, of course. But think about how they got there. This is the end result. But what did the process look like before that? So if you go to buy the bike, whatever the list price is what you purchase it for. The iPhone, of course, is whatever you purchase it for. And the chocolates, you buy the box of chocolates that has a set price. So how did the price get there? Well, the price got there because management decided they would like to generate a certain return. And that return is profit margin. So if they would like a net profit margin on these products, they have to first determine what the costs were. Because if you don't refine your costs, how will you ever reach your profit targets or your profit margins? So the thing we have to think about is the selling price less the cost of the product will give us our gross profit, okay? And that gross profit is held as a way to cover the remaining operating costs. So the higher the gross profit, the better. Now, the production process for these items here, they're quite uniquely different, and they involve different processes. So we're going to go through a couple of them tonight. I'll give you a sample of one anyways. There are two. So for manufacturing costs, when we think about what goes into this, so if we think about what goes into manufacturing, we have to think about one of those items. You have your raw materials, for the bike, it might be titanium, or for the iPhones, it's going to be metal or plastic or glass. And for the chocolates, it's going to be milk and sugar and, et cetera, packaging. So, we have to think about all these different materials that go into producing that one item. Well, usually it takes labor. So we have to think about who is working on this and what does that look like and what does it cost us and how do we determine that cost? And then the last one is manufacturing overhead. Now, manufacturing overhead is, it's there. We don't necessarily see it, like, the lights that are on, the utilities that we use, the janitorial service that comes in overnight. That's all overhead. And if all of these costs relate to the manufacturing process, they are a manufacturing overhead cost and should be attached to that product. Okay, so those are just a few examples. So let's look at them individually. So direct materials. Direct in cost accounting means I can specifically trace it. I have an invoice, I can see the product, there it is. I can map the two together. Okay, easy to find. So the raw components of any product. And they can be physically and directly associated with the finished product during the process. Direct materials are not always used up during the operating period. So it's possible that at the end of the period, we will have a direct materials inventory. So on the balance sheet, we have an asset, which is raw material, okay? So it's an asset and it's also going to be expensed as a cost of goods manufactured later on. Now, we can say that some of those materials are indirect. They're not really part of the finished product, or maybe they're just impractical and we just don't really need to directly trace them. It could just be, a byproduct of the main material that we're putting in there. Not too often, but sometimes, the production manager might just say, I'm not accounting for it. Just put it into the overhead. So an indirect cost is really overhead. So it might just be easier to trace it that way. Now, in terms of labor, we have two types of labor. We have direct or indirect. The direct labor, normally in the form of a per hour cost. So if I work 10 hours and it's $1 an hour, it's $10. Okay, I can directly trace the hours to the rate of pay, and I can map them out together. Indirect labor is where you would find, like a salaried manager or employee, where their employment can really be all over. They're not tapped to a time clock, but they're paid a salary. So we can't directly trace their actions with the product. So it's indirect, and that's very common. In terms of manufacturing overhead, similar to the ones that I just mentioned, they're indirectly associated with manufacturing, okay? If it happens within the facility where the manufacturing is occurring, it is manufacturing overhead. If the costs are incurred in the administration building and there's no manufacturing happening in the administration building, they are not manufacturing overhead costs, because it has nothing to do with manufacturing, okay? Just where it happens. So machinery has depreciation, that's overhead. We can't directly trace it. Utilities is another one, rent, property taxes, salaries, insurance, all these things are indirect. They're part of it, we just can't directly trace it. So the next question then becomes, well, how do I attach it to a product? Well, we'll talk about that a little bit later. Maybe not tonight, but we will certainly in the next lesson, because it's a whole chapter on its own. So then we come to this intersection of product versus period cost. And what that really means is it manufacturing or is it administration? Product being manufacturing, period meaning administration. If it's not occurring in the manufacturing facility, it is not a manufacturing cost, period. See, period costs. Period costs are admin costs that have nothing to do with manufacturing. Marketing, could be the president's salary, could be shipping, could be advertising, those sorts of things after the product's done, but they're not manufacturing costs, okay? So the main components then for product costs will be your direct materials, your direct labor, and your manufacturing overhead, okay? And if you can start thinking about what kinds of items would be attached to those three things, then it becomes a lot easier. Now, these are really cost of goods manufactured, okay? We're costing all of these. They're all going to go together, which we'll talk about in a moment. So period costs are charged to expenses as they're incurred. They're non-manufacturing. I cannot emphasize that enough. And looking at more selling and administration costs after the product has been produced. Okay, so it's the after effect. And if we look at it this way, it might help, really just looking at separating them and then identifying them visually where they land. But I mean, period costs are anything but manufacturing costs. That's just the easiest common sense way to think about it. So, selling expenses, admin expenses, the advertising, the insurance on the administration building would not be manufacturing costs, but insurance on the manufacturing building would be overhead for manufacturing. So we just have to be really careful how we allocate the costs between these two activities. So manufacturing costs are the cost of the goods manufactured, materials, labor, both direct, and then your indirect costs for manufacturing. So here we have an example of a snowboard factory, some of the costs that your snowboard factory would incur, and then we'd have to assign them. So if we look at the material cost per board, of course it's going to be direct material. I can directly trace that to the board. Labor cost, direct labor, I can trace to making that one board. I will know how long it takes to actually manufacture one board. And then depreciation on the factory equipment, of course, would be overhead because I cannot directly trace it to that board. It's depreciation. It's an allocation, as we learned in financial accounting, okay? Property taxes on a factory building. Okay, well, the factory building, that's key. So yeah, it is overhead. We can't directly trace it. Advertising costs, well, it's after the product has been made, because no point advertising something I don't have. So it's a period cost. It has nothing to do with manufacturing. Sales commission, well, I have to make the board first before I can sell it. So it's not part of the manufacturing process. So therefore it's a period cost. Maintenance salaries. So this is for the factory. So very specific. They've told us that is part of the facility where the product is being made. That makes a big difference. So $45,000 per year will be overhead because we can't directly trace it to the surfboard. And then the salary of the manager, well, again, it's a salary. It would be really hard to trace all of that time to a specific product. So again, we use that as overhead. And then the cost of shipping the boards at $8 per board. Well, it's a finished product and somebody's purchased it already, or we're sending it to a store that purchased it from us. And so this is sort of after it's been produced. It has nothing to do with the actual production. Okay, so it's a period cost. All right, so product versus period costs. If they produce 10,000 snowboards for the first year, what's the total manufacturing cost? Well, we know that manufacturing costs are three things: direct materials, direct labor, and overhead. Okay, so if the material costs $30 per unit, we have $300,000 at 10,000 units. The labor cost is 40 at 10,000 units, so 400,000. And then we have the depreciation. So all this overhead is going here. Now, later on, we'll see how we can allocate overhead based on a rate. But for now, we'll just assume it's $25,000. So our total manufacturing cost will also have to include all the overhead costs that go into this. Factory on the building, this is for the whole year, so it's okay. Salaries, of course, because they're indirect, and the plant manager specifically, also indirect. So our total manufacturing costs for these snowboards, 10,000 of them anyways, $846,000. Okay. Good. Any questions so far? So far, so good? All right, good. So this question here is talking about, we're going to think about a bike company. They have tires, salaries of employees who put tires on the wheels, and depreciation, advertising expenses, lubricants, spokes, salary of a factory manager, etc. Okay. So what we need to do here is classify each cost as direct materials, direct labor, overhead, or a period cost. Okay. So this is a bike company. So tires is a material, spokes, the handlebars, all the components that will be assembled together are direct materials. Now the salaries, of course, we know that we can't actually trace them directly to these bikes. They're salaries. So we'd have a really hard time doing that. So they're indirect. Okay. Oh, that shouldn't be there. That should be overhead because they're salaries. Oh, no, I think I can argue that one. I think that's why I put it here. If the big question, if the employees who are salaried are only putting tires on the wheels and they do nothing else, then yes, it can be direct. The problem is, if they float through the production process, it's no longer direct. Ideally, we'd like to have as many direct cost categories in our accounting records. It just makes life easier because we don't have to estimate as much. So, okay, if you're just doing this job, it can be direct, but I would tend to put it as indirect, even though I like direct costs. Factory depreciation. Again, can't trace depreciation. Lubricants, well, how do we trace it for each machine? I mean, it's like cleaning supplies. You probably could figure it out, but not in an economically feasible way. It would cost too much. And then salary of a factory manager. So of course, That's hard to pinpoint. And the salary of factory maintenance employees. Okay, fine, fair enough. We can do that. Advertising expense after we've produced has nothing to do with the production of the bikes. Okay, so those are nice and easy. Okay, any questions? So far, so good. All right. Income statement, you're all familiar with this. Great. But what we're trying to do here in managerial accounting is try to figure out how to produce a cost of goods sold figure with a periodic inventory system. And really what we're trying to do is we are trying to think about how a cost of goods sold. What we do here is we have two statements. You're right. So we have the balance sheet and the income statement. And what we need to do is where our ending inventory is on the balance sheet. It is inventory and it's ready for sale. As soon as it's sold, it jumps off the income statement, off the balance sheet to the income statement. The cost of the good that I just sold would have been already determined through the cost of goods manufactured process. So we already know that. It's already attached to the product. It's sitting there at whatever it cost us to produce. So once we sell it, we already know the cost attached to it. So we have to sell it for a price that equals our expected gross profit margin. Okay. So the cost of the goods that are sold is what we're doing. Okay. So really all the hard work's done already in the process. Once it lands ready for sale, it's already done. We just have to track what's sold, and that's easy through a sales process. So here's an example of two different types of cost of goods sold calculations and two different types of businesses. The first one is a merchandiser. So this is where you would go to, your Walmart or, it could be like a furniture store or whatever. They are a merchandiser. They are selling something that's already made. So they're kind of like the middle person, right? The processing happens, I order, I'm wholesaling it from them and I sell it to my customer. So I'm marking it up again. So as a merchandiser, I have beginning inventory plus my cost of goods purchased because I'm adding to the inventory after I buy it. And then whatever I have left in inventory is what I have not sold. So the difference between beginning inventory and cost of goods purchased here and ending inventory, I must have sold it. I must have, or it broke, or it damaged, or we sent it back. So in a manufacturer, we have this beginning finished goods inventory. So basically sitting on my shelf. I have more that I add to it through the process, right? The working process. So what I have sitting there already, plus my cost of goods manufactured and less my ending inventory, I must have sold. What the difference is. It's kind of really the same thing. It's just that it's a different process. The first one, I'm buying it already made. The second one, I'm manufacturing it. So I have to track my own costs. But nonetheless, I mean, the model is the same. They both end up to cost of goods sold. It's the product. The process is different for both of them. Okay. All right, cost of goods sold section. So this is just showing you what it looks like in a statement between the two, a manufacturing company and a merchandising company. So in merchandising, this is where we're buying the product already made. What I want to do is calculate my cost of goods sold here. So I know I have inventory at the beginning of the period, okay? I purchased more, this is what it cost me, okay? So this is what I have sitting in my shelf. Okay, $720,000 worth of inventory. And what I'm going to do is at the end of the month, December 31st, I'm going to go count it. Or I get a printout from my inventory management system or ERP system, whatever you have there. And it says that I have $400,000 worth of inventory. So that means then I had 720 and now I only have 400 left. I must have sold 320,000 worth of inventory. So that is the cost of the goods that I sold, assuming there's no damage, theft, those sorts of things, impairment. For the manufacturing company, a little bit different. Process is the same, the terminology is different. Here, instead of calling it inventory, it's finished goods inventory because I've made the product, okay? So it's still inventory. And the cost of the goods manufactured, it cost me $370,000 to make this inventory that's sitting there, okay? So 90,000 at first cost me, it's already sitting there. I've made some more, it cost me 370. Total inventory sitting on that shelf now is $460,000. If I look at my reports, it'll say actually you only have 80 left. So you must have sold $380,000 worth of inventory. Okay, then that's what it cost to sell it. That's what the cost was attached to the inventory that I sold. It's really, that's all it is. The language is a bit different between the two examples, but for the most part, it's the same thing. All right. What does this look like in terms of process? So if I throw the term total manufacturing costs, what that means is cost of goods manufactured. It's the same thing. The total manufacturing cost, direct materials, direct labor, and manufacturing overhead. Okay. So these are all called, like if you start with, think of it as a flow chart, and you start on the left, and you start with direct materials, direct labor, and manufacturing overhead. You start with all of those. And then the process starts. You're going to make something. Okay. This is called work in process. Think of it as a blender. Okay. What happens with the blender is it's sitting there ready to make. Pour in all your ingredients, raw material, labor, and overhead, and press start. Mix it all together. Okay. So as this work in process is happening, bikes are produced, chocolates are produced, iPhones are produced. Now, let's say, for example, Friday, November 27th is your month cutoff. Okay, you're going to do a report then. At that time, that whole work in process account might not be done yet, but that's okay. It's natural. We don't have to finish it on certain days. But it's still inventory, and I need to account for it on that day. So we won't cover how to do that, but what I'm saying is work in process is an asset. It's converting materials, labor, and overhead into a final product. So we've just moved some of that materials and into the work in process, and we add the labor and the overhead to help us do that. So work in process is also an inventory account. So now we have direct materials and work in process and ending finished goods, 3 inventory accounts. Okay. So this work in process or blender that you put everything in, we normally have a balance. We don't always finish. You might, but there is the possibility that you don't. You may have a beginning balance, and there will be a value attached to that. It might be 80% done. Well, it still has a value attached to it. And then you're going to add more. Okay, you're going to add more to work in process, cost of goods manufactured, or all those inventory items. And at the end, you'll have finished products, and they'll come out of there, and they'll jump out of the blender, and they'll go into the inventory shelf. It's finished. It's finished goods. But you're also going to have some left in work in process. You're going to have an ending balance. So what you're really trying to do is you say, look, I'm going to start with my beginning. I'm going to add all these things in, materials, labor, overhead. And at the end, I'm going to also have a work in process balance because I can't finish them all. So knowing what I have at the beginning, what I have at the end, and what got put in between, whatever the difference is, whatever's left was probably finished, right? And it's sitting as ending inventory, okay? So here in this flow chart, we start with beginning work in process inventory. We add our manufacturing cost into the blender, okay? And then we have our total cost of work in process here. So it moves down here and we carry on and go, okay, we have their blender half full maybe, less the ending work in process. So that other half must have sold. If I filled that blender to the top and I've only got half left, it must have sold. Okay, we're assuming it sold. It could have been damaged, I don't know. Well, if that's the case, we would have had to have written it off, but we'll assume that's what it is. So the cost of the goods that are manufactured will come out of this, and it sits in ending inventory, and that's the value we attach to it. Okay, so the blender is a good analogy because it kind of makes a bit of sense. Now, wouldn't it be fun to sit around a board table and explain that and draw the charts on the board and different colors, which I would love to do in the classroom, and I always do. It just makes it more fun. But in a formal meeting, we don't always get the chance to do that. So what we do is we put it into a formal report like this: cost of goods manufactured schedule or report. And this is what we convert that flow chart into a formal statement. And this is what it looks like. So what we have, and there are different variations of this, but this really is saying, look, we're starting with work in process, our blender. It has a balance in it. We didn't get to finish everything, and that's fine. What I'm going to do is I'm going to add some materials to it. Okay, so I start with my inventory of raw materials. I bought some more. I have some left over in inventory. So the difference here, I must have used it, and that's what I used right here, 146,400. Labor, nice and easy. It's direct, easy to find. Get it from accounting, and there it is. And then I have some overhead, all related to manufacturing. So indirect labor, factory repairs, factory utilities, factory depreciation, and factory insurance. That relates to the manufacturing process because it's directly coming from the factory. Okay, so the total manufacturing costs are these three here. Okay, the 146,400, the 175,600, and the 54,800. Those are all totaling 376,800. Okay, now the total cost of work in process then is my beginning plus what I put into it, and that's what I'm left with. Now, if I didn't finish anything, it would be that balance. But I did finish some because my ending balance is 25,200. So that means I must have finished $370,000 worth of ending inventory. Okay. So this is just the formal way of putting it. And it looks nice and neat and tidy. But the flow charts are always more fun, I think, anyways. Any questions about the statement? So far, so good? All right, take that as a yes. What I wanted to do, actually, maybe I'll show this first. Yeah, I'll do this first. So when we talk about a manufacturer and we talk about inventory, again, and we'll see a video about this in a moment. We think of the raw materials, the bits and pieces that we need to put into work in process. And then the work in process is really nicely shown here. We have all the pieces. So the bike would have been a good example where there's lots of assembly and, putting pieces together and making it ready for sale. And then this is the completed good. This is the one that sits on our shelf. Okay. So the balance sheet is going to show all three of these as inventory. Now, we don't show it line by line like that. We would just say manufacturing inventory, or maybe just inventory, right? So it's the combination of these three, and so it does have to be accurate. So again, the balance sheet, one's a merchandising company, one is not, one's manufacturing. The inventory account for merchandising is basically what did I buy during the year and what do I have left over? So whatever is sitting on my shelf is my ending inventory. Now, you probably wouldn't see this on an external statement. You would see this internally. We just don't have room on the formal financial statements to show this detail. We could put it in a note, but the internal financial statements, you would probably see something like this. So we would show the line items. Here they are: finished goods, work in process, raw materials. It's basically breadcrumbs. Right? You're just throwing them out in the trail and making sure you follow each one of them. and they all end up in the same place. That's just another way of showing what happens on the balance sheet. So cost of goods manufactured, let's see if we can do this one together. Again, just thinking of the manufacturing process. So we have some raw materials, work in process inventory. So here we are 1 month. We have a $12,000 balance of material, and work in process inventory. And we have our ending balance. So we bought some materials in March. We had some direct labor in March, and we have some overhead. So what is the cost of goods manufactured schedule for the month of March? Well, we can do the flow chart or we can do the formal statement. They asked us for a statement, but really the flow chart is just the raw way of presenting the statement, cost of goods manufactured statement. So this is what it's going to look like. So we're going to have the beginning balance of work in process of 2,500. We buy some new materials. We start also with the beginning balance because we had inventory there. And that means we have $102,000 worth of direct materials to use, okay, to go into work in process. Now, if we count it at the end of the month, we see that we have $10,000 worth left, which means we didn't use it all in production. We used 92,000 of it. Direct labor, they gave us nice and easy, no calculations required. And then the manufacturing overhead was $220,000. So the total manufacturing costs, your materials used, your direct labor, and your overhead, $387,000. The total cost of your work in process, you're going to add these two together, beginning plus what happened during the month. We're also going to have an ending balance in work in process, $4,000. So that means the total cost of my goods that I manufactured are $385,500. Okay. So that's a nice formal statement. Production might be asking you questions, or maybe they have some questions about comparison to last month, plans for next month, and they may just ask the questions that need to be asked. So in terms of the value chain, we're kind of right in the middle, like we're kind of right here. And when you think of the value chain, we're looking at beginning to end. So if you want to look at R&D, if you have R&D, that's great. But when we start acquiring these raw materials, we want to ensure that the materials are high quality. They're going to stand the test of time because, if they don't, customers will let you know. Or maybe your supply chain changed and you need to seek out other options. Maybe it just doesn't stand up. So the value chain is just part of the way you do business. And then production, of course. Really just thinking about, well-skilled individuals to do the work for you, efficient processes, a safe environment, those sorts of things. Sales and marketing, of course, we want the product to move. We want to sell it. And without selling the product, we really don't have a business. So we need to make this a priority. And then the delivery, of course, that's especially these days, the delivery is becoming not so much a value added. It used to be that if you had something delivered, you'd have to pay for it because it was an extra service. But now with COVID really getting into, again, all of our lives, delivery of items is becoming part of the business model. It just is. To keep businesses going, it just is. So yeah, things are changing quickly. Shop local, right? And then customer relations, again, is a subsequent service, or sort of that value added bit, the warranties, the customer feedback, maybe sales checks in on their customers 1 month after the item's sold or delivered. It's just however you want to communicate with customers. Social media is also a great way to do that. And someone would be monitoring those accounts. So the value chain also looks at internal process. So just-in-time inventory methods. Basically, we just don't want to hold a lot of inventory we're not going to use. We don't want cash sitting on the shelves. We want inventory that we're going to use. So we get this model of just-in-time. It starts reordering at certain points. When we need it, the supplier knows and they send it. And this is more of a total quality management. It just reduces costs. It becomes more efficient, especially if you're using products that are, or materials, that are perishable. I mean, you don't really want them sitting on your shelf for too long. You just want to order them when you need them. Okay, the freshest possible that you need. So this is a really good, ERP system. That really key planning bit and getting those systems integrated enough so they can provide this type of service or information. And really how we're trying to manage efficiency. And ERP systems can be quite complex, but if you have the right people managing them, they work really, really well. We're going to learn a little bit later on about activity-based costing, and this has to do more with overhead allocation. So we're going to be looking at how we refine costs based on activities that consume the overhead. And so it makes it just less of an estimate and more accurate way of costing our product. Sometimes there's not much different between the traditional method and this method. And then creating proper incentives. How do we incentivize, employees or managers? We're going to talk about that a little bit later on in the course, but we need to think about them now in terms of, does this fit into our business model? Does it fit into our corporate social responsibility? And is it really just the mantra of the organization? So we really have to just, internalize the ethics that we actually display, not just talk about. And CSR, or corporate social responsibility, a lot of publicly traded companies that all speak to corporate social responsibility, they tend to say what they do, but not so much how and if it's working. They don't tend to supply metrics. It tends to be more of an advertising, I think. Not to say they don't do it, it's just hard to know how effective it's been. Anyways, so that's just a sidestep there. But anyways, corporate social responsibility, looking at, triple bottom line, some use it quadruple bottom line when we think of the environment. And then, yeah, it's different for every company. So it's just really hard to measure. You just have to know your company. Okay, so this is for next week, but I do have a couple more things I want to do with you this evening. So hang tight. I just want to send out just a quick reminder that there's a handout that I'll show you in a moment that I posted to Moodle. There are 2 videos specific to the handout that we'll watch one of them tonight together. And then there are other videos that are posted in Moodle for week 5, and they really cover this material in a bit of a different way. And I really like his series. I've used it for a couple of years, just as it started out being when we did face-to-face classes, that students wanted something more, like just, because they couldn't record sessions. So I found these online on YouTube, and he's fabulous. I really do like his work and the way he explains things. So I've used them quite a lot. And now look, we're virtual. It kind of adds to what we're doing here, explains it really, really, really well. And we have some exercises that we can use it with. So get used to him. He'll be visiting with us for the next 4 weeks. He'll be my guest speaker as we watch his YouTube videos. So what I want to do now is I would like to share my screen again, and I want to point out, where is it here? It is right here. Okay. So hopefully you can see this. This is something I posted in Moodle, and I kind of made a mistake here. I got the videos mixed up. So the bottom one's the chocolate one, the top one's Jelly Belly. But what I did was I put together sort of definitions, concepts in a document, and ask you to watch the 2 videos and see if you can extrapolate these terms from those videos. And what that does is it gives you a chance to kind of focus on, like, point number 2 here, cost assignment. What is an indirect versus direct cost? Okay, well, I know what the definition is, but what does it look like? How can I explain it to somebody? How can I pull an example and say it would be something like this? And so that's why I put this in the format it's in, because I'm just trying to draw out the key components and looking at how can I attach this to something I might not normally see. And maybe you work in something like this. Maybe you work in an environment where these are actually very applicable, or some of us don't. And so we're trying to really just attach something to these words and applications and definitions, and really get to see what it might look like. So these are questions that kind of guide us through that. And so it's a Word document. You can type in. It is not an assignment. It is just simply to apply the cost terms, because we will be using these for the rest of this course. So the next 4 weeks, we will still be using these terms. We are in cost accounting, in managerial accounting for the remainder of this course. And this will help you walk through that. So to demonstrate, what I wanted to do was I wanted to share the video with you, one of them anyways. And I did a presentation last week at a conference, and I showed 3 videos and they all worked. So I'm crossing my fingers that I don't get booted out of my Zoom session here. But I just need to find the video first, because I had a couple of them. Oh, there it is there. Okay, so I will go back to Zoom and I will share this with you. Now I do have, if you can't hear it or see it, please just yell out, because when I've got my screen on, I can't see anybody. I can't see hand signals or anything. So just call out if you cannot hear it. And I'll stop it and start again and see if I can do that. If not, I don't know, plan B. Okay, so it's going to be here. So what I want you to do when you are watching this is to think about the terms that we talked about this evening. And can everyone see my screen? Can you see the YouTube video, or the first clip?
Yep.
Okay, perfect. Good. So if the sound doesn't come through, please scream and let me know. It should. So what I want you to think about is raw materials, direct labor, indirect labor, overhead, the facility itself, and just kind of watching what this looks like, okay? And think about the different processes. And then we'll go back to that handout and we'll talk about it, okay? So here we go. Let's see if this works.
Someone once said that 9 out of 10 people like chocolate, and the 10th person is lying. Which may be why worldwide production has reached a staggering 3 million tonnes. But turning these fleshy fruits into melt-in-the-mouth treats is an epic endeavour. So, how do they do it? In his North London shop, Paul Young is preparing a new batch of chocolate for his award-winning truffles.
Just by giving someone the best piece of chocolate they've ever tasted, make their day. I mean, you can ruin it as well if they taste it, don't like it. But people come into the shop, they taste a piece of nice chocolate, they go away having tried a truffle in the shop, and they leave the shop with a big smile on their face. That's the whole reason why I'm doing it.
Since its discovery in Central America over 3,000 years ago, the whole world has developed a taste for chocolate. But not all chocolate tastes the same. Like coffee, tea and wine, soil, climate and processing all affect the final flavour.
If someone comes into my shop never having tried anything other than a blended supermarket chocolate, brilliant. We've got 25 others to show them. We start them with a really mild, delicate chocolate, and then they'll come back and have the more exotic, and then a woody, and an earthy, and a spicy.
The source of all this chocolate lies in the tropics. Theobroma cacao, the cocoa tree, only grows in these hot, humid latitudes, within 1,000 kilometres of the equator. Here in the Malaysian cocoa boards plantation, near the town of Temelo, they harvest over 100 hectares of cocoa trees every year. But first, they have to grow the trees. The tiny seeds are planted in bags filled with the coarse, damp soil they need to grow. After a few days, the seeds begin to sprout. And after 4 weeks, they've shot up to 30 centimetres. But it still takes 3 years for these seedlings to grow into trees and start bearing fruit. After waiting that long, The last thing you want is for some pesky insect to come along and nibble into your profit margin. So here they protect each seed in a plastic sleeve. Creepy crawlies aren't the only problem for the cocoa farmers. Getting the fruit off the tree is a challenge. They don't simply fall from the trees. They have to be cut off, one by one. With temperatures in the high 30s, this is hot, hard work, and each of these workers will harvest 1,500 cocoa pods a day. Once the workers have piled up the pods, they're hauled off for processing on another part of the plantation. Extracting the seeds is also done by hand. The seeds inside were once used as currency. One would buy a tomato, 4 a pumpkin, and if you really wanted to flash your cash, 100 would get you a turkey. As the local wildlife will tell you, the slippery membrane may taste sweet, but the seeds inside are hard and extremely bitter. Turning them into a tasty treat means leaving them to ferment in vats for 6 days. This breaks down the bitterness and starts to release the essential chocolate flavours. After just the right amount of fermentation, they're laid out in the sun, slowly drying out the unwanted skin and leaving behind raw, dark cocoa beans, ready to be turned into chocolate. But that means a journey to the grinding factory. Tanjung Pelepus, one of the busiest and fastest growing ports in all of Asia. Ships from all over the world dock here. And in the heart of the port is JB Cocoa. Every year they take delivery of 65,000 tonnes of cocoa beans from Malaysia, Indonesia and Africa. They arrive in 1 million of these 65-kilo sacks, which are graded and stacked in this vast warehouse. But these beans still don't taste much like chocolate. First they have to be cleaned to get rid of any impurities and the useless outer shell removed using a process called winnowing. The part of the bean that's left is called the nib. To bring out the chocolatey flavour, these nibs are roasted for half an hour. This develops the aroma, but transforming them into something more appetising means a go in the grinder. Grinding releases the fat inside, and out comes a river of molten cocoa, known as cocoa liquor. To make fine chocolate, this liquor will have to be ground several more times and then mixed with sugar and emulsifiers to produce a solid block of dark chocolate. But of course not everyone likes dark chocolate. So how do they turn this rich liquor into milk and white chocolate? The solution? Squeeze the living daylights out of it. In this press, the largest of its type in the world, huge hydraulic rams compress the liquor. Out pours cocoa butter. Mixing this with the cocoa liquor, milk and sugar creates milk chocolate, and leaving out the liquor gives you white chocolate. What's left behind are slabs of dry cocoa solids, used in anything from chocolate drinks to cakes. Back in North London, Paul's award-winning confections are made with rich, dark chocolate. Part of chocolate's appeal is that it can be combined with so many other flavours.
We're coming into spring, so we've had a lot of florals like lavender, jasmine, lots of teas flavours, less of the wintry, spicy, warming flavours. And into summer, lots of Japanese, Asian, citrusy flavours.
And if you're feeling really brave, how about Marmite flavour? The current batch is a more appealing sounding passion fruit and Maya honey truffle.
There we go. That's full. It just needs to rest now for about 12 hours to set.
The final covering of chocolate goes on, and once it's set, it's time to see if all that effort has paid off.
good. Silky smooth, thin shell, balance of flavour.
All right. Well, I know I'd like to have some. So what do you think? Do you, does it kind of help? I'll just bring up that sheet again. Does it kind of help put some of these terms into perspective? That's at least the, that was my hope anyways. But let's maybe just take a couple minutes to think about what was presented in that. I mean, there were quite a few different scenes, and you know, you had the farm, the cocoa farm, and then you had the actual producer. So you could sort of banter back and forth between, you know, what these types of costs would be in each of those environments. That's fine. We didn't get to see as much in the processing of the cocoa beans. We sort of jumped from the harvest right to the shipping. So we didn't actually see them being bagged and what the rest of that drying process looked like, but we get a pretty good idea of what it might be. The idea behind this is more of, okay, so what kind of activities were happening? What actions were there that could help us attach some of these terms to, you know, to the actual, you know, physical parts. So I'll start. If we think of cost objects, I mean, you can think of a few things actually. Like the bags of cocoa beans would be a cost object, I mean, from a farmer's perspective, because that is the unit that's sold. So everything that goes into creating that burlap sack of cocoa beans it should attach itself to there. So it could be the labor, it could be processing time, it could be the facilities and all those things. And whatever goes into the total cost of creating that burlap sack of cocoa beans, the cocoa bean sack is the cost object. So we do have to attach it, because when we sell that to the manufacturer, they're buying that based on our profit margins. So we would need to set a certain profit margin, therefore we need to know what our costs are. So it goes hand in hand. And so when you think about the farm, you know, there's, you know, there are a few things there. There was the tractor, there was the, you know, the labor, you know, can you imagine, you know, cutting all those cocoa pods off by hand? And that would be, I mean, it's hard to know if it's salaried or not, but maybe it's piecemeal, who knows? Then of course that's direct, but we'd have to make an assumption there whether it's salaried or not. And then the actual processing of the cocoa pods. So you saw there that, you know, within the barn there, or the processing facility, that they're hand processing those cocoa beans out of the pods. And then of course raking them to dry them. They probably have a much larger drying area. They're just showing us a little portion of it, but raking them all, and you know, you saw the volume that went through there. Quite a lot of acres there to harvest those types of beans, and we only saw a snippet of it. So again, you know, we saw a little bit of, you know, the labor involved, very hands-on labor. Some would think it's probably not efficient, but when you think of the product itself and the demand for that product worldwide, which is, I think, becoming problematic because they can't keep up with the demand and there's a shortage, and, you know, the resources that it takes, and the water that it takes to grow plants like that is concerning. And so there's a high demand for the product. So it does fetch a fairly good premium, especially in the chocolate shop that you saw there. Very much a delicacy shop. Some very good quality chocolate that was being produced there. And so we move away from the farm and we move into, you know, we saw actually three, the manufacturing facility and then the chocolatier. So if we go to the manufacturing facility and we think about direct and indirect costs, I mean, as soon as we walked into there, we saw the machinery, we saw the research and development, we saw them, you know, cleaning the beans, grinding the beans, we saw them press the oil out of the cocoa beans, use the powder for baking, cake mixes, etc. The oil can also be sold. So that's called a split off point. So we have one raw material that splits off into 3 products. And so we could see the multi-uses of this cocoa bean. And of course, if you're going to make chocolate, it goes on to the chocolate slurry, or whatever they call it there, liqueur. So if we saw the machinery there, there's lots of depreciation. That would be a manufacturing overhead cost, the maintenance of that machinery. Did you see how clean the facility was? You saw someone sweeping in there. I would suspect that they've got someone coming in probably at the end of every day doing the janitorial work, washing the floors, wiping down the machinery that's not in use, disinfecting, those sorts of processes. And then, you moved on to the labor. You saw folks working within the facility, and again, hard to know if they're by the hour or if they're salaried. So again, direct versus the indirect cost. And all the other things we saw, but didn't really connect, like the lights that were on, the electricity that was used to run the machines, the building itself that this was located in. So we didn't see all of that. We also didn't see, actually we did, we saw a little snippet of the delivery of the cocoa beans and them opening the burlap sacks and putting them into the grate so they could be sorted and cleaned. So again, the shipping and receiving bit, depending if it's direct or indirect labor, could also be attached to that. And then if we move on to that, the cost drivers, basically the labor, very labor intensive, all of this. Specifically, actually no all, the farming, the manufacturing, and the chocolatier. It was, the chocolatier was, a very niche market. It's a very specialized product, handmade. And it looks so good. Probably get sick after the first 3 truffles, but wow, they sure look good. But it's very hands-on. You saw the owner just moving the chocolate around and melting it, and of course putting them into the molds, and then chilling it. So, and then you had the people up front, whether they're direct or indirect labor, we don't know. But you had the shop itself, the lights that were on. You can see the packaging that some of that came in. The molds, just the utensils he was using, all of that. There's lots of raw material, which was the chocolate. We didn't see him actually mix it. Normally what would happen in the chocolatier shop like that is that they would buy the bricks of chocolate. And like he was saying, it depends on the season. So it would depend where the chocolate came from. But they made, the factory would sell the bricked up chocolate, and the chocolatier would buy it from them. He is not producing, he's not running the cocoa beans through that process. He's buying it already done, I'm assuming. So that would be his raw material. That would be the raw chocolate, probably already sweetened. Or maybe he sweetens it himself. Maybe he adds certain things to it, but it's very much like wine, depending on the region and the variety of cocoa bean. The taste will change. And so very, very particular. So if we think about all those, locations, those places, we can actually walk through this a little bit more easily. And if we go to the variable or fixed cost, think of this as direct and indirect. Now, one of the videos from YouTube that I posted for you, Moodle, does talk about fixed and variable costs, but in a nutshell, variable costs will change with output. So the more beans, cocoa beans, that I need to meet the orders, the more it's going to cost me because I need more beans. Okay, so as the number of bags of, or burlap bags of beans I order, my cost will go up. It's variable. It changes with output or demand. Okay. If you use your heat now more in wintertime, well, it's variable. It changes with output. The more you use, the more it's going to cost you. So it changes. The sales commissions that salesmen receive will change with output. The more they sell, the more commission they get. So it's cause and effect, right? It changes. Whereas fixed costs don't change with output. So think of this as going out for dinner with a bunch of friends in the good old days, right? And there's $100 bill and you guys decide to split it 5 ways. Great. 20 bucks a person. It's all good. Had a great night. No problem. But the $100 doesn't change. But so the $100 is fixed, but it changes in terms of per person, depending how many people are there. If I have 2 people, it's $50 per person. If I have 5 people, it's $20 per person. So it's changing that way, but the $100 itself doesn't change. So variable cost per unit or per person would change, okay? Variable cost per unit is going to stay the same, the variable cost per unit, but the total cost will change because the more that I have, the higher the cost. Whereas the fixed costs don't react that way. It's just a fixed amount and it doesn't change. It's just inverse with the number of units. So I just spread out the fixed cost amongst more units, then the less cost per unit it becomes. But the cost itself doesn't change. So for example, in those videos, we saw a lot of machinery, we saw a lot of production equipment, we saw buildings, we saw tractors, we saw a shop, we saw the glass containers or the shelves that the chocolates were displayed in. Those are all assets. They probably have depreciation attached to them. Depreciation is a fixed cost. It doesn't change with output. It doesn't matter how many chocolates the chocolatier sells. The cost of those assets and the depreciation will not change. Now, variable costs, chocolate, the paper cups for the chocolates, the sugar if he's sweetening it himself, that will change. That's variable because it changes with the output, okay? The utilities, of course, they might be fixed because they don't change. Maybe the rate doesn't change. Maybe it's, you know, $100 a month for water. We don't know. Or maybe it's based on usage and it's variable. So whatever's fixed doesn't change with output. Whatever is variable does change with output. And in the last bit here, the manufacturing sector, talking about direct materials inventory, work in process, we saw a lot of that, and finished goods inventory. So the opening clip was the chocolatier, you know, moving the chocolate, or the liquid chocolate, just to work it and thicken it up and make it more pliable to work with, and probably sweeter, I'm sure. So that chocolate is inventory, believe it or not. It's a direct material, okay? Because the finished product is the hardened truffle. So the material is sitting there on the marble, he's moving it around, he's put it on there, and as he's working it, it's a work in process, right? He may be adding something to it, or maybe he's put them in the mold and he adds the sprinkles on top, or the sugar, or whatever, the flowers. That's the work in process. So in the molds is work in process. He said it took 24 hours to set. Until they come out of those molds, it is work in process. It hasn't finished setting yet. So that's work in process inventory, okay? When they come out of the molds and they're in the paper cups and they're in the front for people to buy, it is finished inventory, okay? Finished goods inventory. In terms of the factory, we didn't see the end chocolate product. There used to be another video I showed, but I can't access it anymore. I actually showed finished. No, actually, the chocolatier showed some of the bunnies and stuff, but the actual facility didn't show its final product. But I would assume it's in multiple different forms. It's cocoa powder. Or maybe they sell it in bulk. Who knows? But they are selling that. We just don't know how they're selling it and in what capacity. So they would have had some of that direct materials inventory, all the cocoa butter, the powder, and of course the chocolate, the liquid chocolate. Now the work in process, again, sort of the same thing until it's actually packaged, not inventory, and then the finished goods inventory is ready for sale. So the cocoa beans then, once the cocoa beans were packaged in the burlap sacks, that's when that was a finished product. So that's really all we saw from the farm were the bagged cocoa beans for shipment. So it's just asking you for direct materials and work in process, finished goods, etc. And you can do this with a Jelly Belly video if you want. If you want to go and test your knowledge, you can do that. Now, when we talk about inventoriable or period costs, again, know that period costs are for administration only. Inventoriable costs are for the manufacturing process. So they're inventoried, they land on the balance sheet, okay? It's an asset, and I convert the asset into something for sale, okay, in manufacturing. So direct materials, all the cocoa beans, the blocks of chocolate they would have had, you know, the sugar that it would have had, the burlap sacks that the farmer would have been a material, because we need that to package the beans. And labor is really simple. It's either by wage or by salary. So unless we know that, it's hard to tell. And the indirect manufacturing overhead, which we saw there, again, all three of these go into work in process. They go into the blender, okay? And you saw that in all of those three clips. They're working it, right? They're in the process. That is work in process. And you saw the people working it. You saw the output of it, okay? So think of those clips as being the blender. That is the work in action, right? The work in process. Period costs, again, if we can think of some in those examples, well, I'm thinking of the chocolatier maybe, the boxes that he might have used for packaging is not really a manufacturing cost. It's more of a shipping or packaging cost. Now, you're going to price it so it includes the packaging, but it's not part of the manufacturing. You're not making boxes, you're making the chocolate. The cocoa farm, trying to think of what that would look like in terms of a period cost. Didn't really see any there. No administration, no nothing. I think a part of it, when we see shipping there.
I have a quick question about like the cocoa farm. Like, what about like the mortgage on the land? Would that be a period cost, or would that be in the manufacturing cost?
You would probably allocate it to the manufacturing cost because it's being harvested. So the pods are being harvested from the trees, and the trees would be the assets. But it is part of the overhead. So you'd need those trees to, you know, for the cocoa beans. So yeah, the amortization, you wouldn't amortize the land because it's just one of those assets. But the mortgage, absolutely. The mortgage payment on the farm or the property there, absolutely. That's considered, because it's usually attached to a building more so. So absolutely, yeah, the mortgage payment or rent payment would be considered overhead. Yeah, for the farm. Yeah, good question. Yeah, it looks like a really pretty part of the world, that's for sure. I've been to Malaysia, but I never visited a cocoa farm there. Guess I should have been there. Coffee, yes, but no chocolate. Yeah, thinking of the other machinery there, like the facility was, you know, the chocolate production facility was quite noticeable, but the shipping, you know, they mentioned going to the shipyard and transporting all of those cocoa or burlap bags of cocoa beans and what that looked like. So if you think of the shipping process, you know, where would you classify the shipping? Would it be a material? No. Because it's not going into the product. Is it labor? No. It's not going into the processing of those bundles or bags of cocoa beans. The shipping is really the after effect, right? It's just more of the transport to get it to where it needs to be. You would definitely add it to the cost of your product, but it's not really a manufacturing cost. So it'd be a period cost. That would be one example of those. Yeah, I'm just trying to think of something else, maybe in the chocolatier shop. They didn't really show us a lot about the shop, just more about him, you know, explaining the chocolate and how he made it. But yeah, I didn't really get a good shot of the shop there. I can't think of anything off the top of my head.
Maybe the packaging design for the packages that the chocolate was wrapped in, would that be a period cost?
Yeah, I would say that's a period cost. Because it's not really part of the manufacturing of the product. It's just more of, make it look nice when you sell it. Yeah. But, when you look at Jelly Belly, if you look at their video, I think this one they show the actual, because it goes in batches for jelly beans. And so the batches would go in a box. So you get like a 25-pound box of jelly beans that would be for bulk retail outlets. And so the box itself had to become part of the manufacturing process because they can't sell individual jelly beans. So they'd ship them with the boxes. So the boxes themselves were considered raw material. Whereas the chocolate is different because customers come into the shop, buy the chocolate, and they probably put them in a box. Now, whether they include that as a period cost or not, or part of the total work in process or ending finished goods, maybe the chocolate is already priced to include the boxes. It just really depends how they want to do that. Yeah, it's more for the chocolate shop. It's more presence, not presence, but for the showmanship, I guess, of the chocolate and the, I'm looking for the right word. I'm not finding the right one, but just more of the significance of going to a chocolatier versus a big box store, right? It's very special. And there's a few around that I can think of, especially in Vancouver Island and Victoria. There's a couple of old chocolate shops there from my grandmother used to take me there, and you've been there, before her time. So they're very traditional. And so when you go there and buy chocolate, you just need one because it's that good. So the packaging sometimes becomes the product, and they have very distinct packaging. So some stores might include that as part of their cost of goods sold, or cost of goods manufactured. So it just depends where they want to put it. Yeah, sometimes it's just easier from a cost perspective. If you think about how you create your general ledger, a lot of times like just put it to cost of goods manufactured, just put it in there, because we know we have to do it anyways to cost the product because we have to recoup that. And sometimes it's just easier. It's going to be accounted for no matter what, but per unit, let's just throw in the packaging. It's just so much easier. So that's what's done in practice a lot. It's just easier to manage. Yeah, these are really fun videos. So these go through sort of all of these here, all this terminology. The other video was, I don't think I have it up actually. It's a Jelly Belly video, but these are mixed up. So if you want the Jelly Belly one, go to chocolate. I don't know why I did that. It was late, I guess. And so I'm hoping that this will, sort of help bring to the surface a lot of these observations or categorization of these terms. They become more important as we move forward through the rest of the course, because when we start the material next week in cost functions and cost behavior, break-even analysis, we're going to be using the terminology a lot. And so it's important that you get a really good handle on what these terms mean and what they are, because we won't really have time to go back to them. The videos that I posted also bring out these examples as well. So between this, the videos, the slides, and your resources that you have, and I'll be putting up some more homework questions for you as well as we sort of move through the material. It just becomes more second nature. So it will become a lot easier the more that we use it. But just sort of forewarning you that for the next, well, specifically next week, we'll be using the terminology a lot. But what I do is I just repeat it. So I sound like a broken record, skipped record, and just to bring home the point, like just reminding you what these are, and just kind of slipping them in here and there. So even if you're not quite getting them, I'll just sort of bring us back as to why it should be that way and why it looks that way it does. Are there any questions about any of these questions on the handout? Or I know you probably haven't had a chance to look at it, but I'm hoping that it's fairly straightforward. Just looking, I think I've got it all here. Yeah, I think I do. Okay. Yep, I think I got it all there. Okay, so any questions about any of the videos, or are you curious about something, or has anyone worked with this material before? Or work in environments that use this material? And in manufacturing? Or maybe used it in service? Go ahead, Marie.
Yeah, I'm pretty familiar with all of this since this is pretty much what we do. And for my company, the biggest challenge is always related to shipping and also the change in currency all the time.
Yes.
Because when you develop a product that actually sell, and then you order repeat after repeat after repeat, and none of them are matching.
Yeah, it's a bit of a problem. I know that the company I do contract work for, we do a lot of ordering across the border, so the US dollar exchange all the time, and we order some things, not a lot, but some from China as well. And so the currency, especially the US dollar, because it changes every day, and having to track that as a cost, because it does cost you more money, and if you order it on one day and pay for it another, the exchange rate's different. And so you have gain or sell on exchange rates, which becomes just a lot of tracking of information. But you really have to watch your costs, because you just don't know with that foreign exchange what's going to happen. And you can book it, hedge your bets a little, but buy some US dollars to purchase those or wire them. But it does become a lot more challenging, for sure. Yeah, it's a good point, actually, with the foreign exchange.
Yeah, but your class was really helpful, and it was good for me to see all the translation, because I know all these terms in French, but I didn't know in English. So thank you very much. That was super clear.
Okay, good. I think the handout does a good job of trying to, bring all those terms to the surface and applying them to sort of, more applicable. There's no answers for that worksheet, because it could be anything that you want it to be. But the key thing is understanding what it is, like that definition of what it could look like. And as we start going through the material next week and watching the other videos that I posted from YouTube, he also walks through the examples about why, and provides a few examples as well, and kind of stretches it out just a little bit more. And the great thing about his videos is that they're between 5 and 6 minutes each. So it's not one long, drawn out video. You can just pick and choose which one you want to watch. And I've labeled them hopefully clearly enough where you can actually go and do that. So you can just pick and choose which ones you would like. So hopefully that's helpful, and hopefully it helps with the handout. But I would suggest going through, just even in the readings, the more that you start seeing how these are applied, the easier it becomes. And I think that the biggest takeaway from this evening is more of, where would I see it? And where is it going to appear on my financial statements? And where is it going to appear on any reports that are internal? Because that's the information that managers are using to make decisions. And so if we can figure out where it lands and where we actually see it, it becomes much more helpful. Doesn't do too much in a book, because we don't see it live working with it, except for those of you that have the experience with it. It's always easier from a book. But I think if we can see where it should land, it is really, really helpful. So I think the videos will be a big part of that. Any other questions? I haven't looked at your assignments yet. I think I won't have time to look at them until Friday. My week's pretty nutty. All right. Well, if you do have any questions, please just send me a message. I'll check my emails throughout the day. And if I don't get back to you during the day, it'll be in the evening, as best I can. So anyways, I'll stop recording now. So for those of you watching after the fact, I hope you enjoyed it, and we'll see you next week.